Let's talk about the stock market. It is experiencing heavy volatility, if you haven't noticed, here in recent weeks. And this is because the Fed remains focused on lowering inflation. But how will it impact your investments? And what is the outlook for us going forward? Here with some answers this afternoon, financial expert and host of the Good Money podcast, Derek Kinney, with us once again. Hey, Derek.
Hi, Jason. Good to be with you.
Good to have you again today. I think this is something on a lot of people's minds, especially if they have an IRA or a 401k and they're able to get in there and make investments as well in those, and they're seeing what the balances have been doing. So let's talk about inflation first, because it affects everything that goes on in the markets. What is the current outlook on inflation?
Well, the outlook is all hands on deck. And we saw Friday when Fed Chairman Jerome Powell talked about inflation. In a 7-minute talk, it literally rocked Wall Street, dropping at 1,000 points on Friday. And here's what he said. Not only is inflation still high, but they likely will continue raising rates to help offset it. What they don't want to do is create a situation of what's called hyperinflation or create a recession. They want to attack this thing, but it may cause pain, not just in the economy, but for many people watching who have money in the stock market.
Now, this is all because the economy has been hot. It can get too hot, which is why they start to apply the brakes and see if they can slow it down. So a lot of people, Derek, might be wondering, why does the Fed keep on wanting to raise interest rates? Because, it doesn't help me out if I'm trying to buy a home or trying to buy a car or whatever. Why do they keep doing that?
Well, the bottom line is they don't want to create a situation where the economy actually overheats. At the same time, what we've seen now is the rising prices coming out of COVID and some other factors have caused, for example, food, the cost of school supplies, the cost of running a family has gone up almost 25% year over year, and it's costing people a bottom line. So that the key right now is, can the Fed monitor this and navigate these treacherous waters without tipping the economy into a recession? So bottom line is people are going to see probably higher interest rates. Houses will cost more, cars will cost more, but can the Fed engineer this? That's really the bet right now. And it's one that really concerns the majority of people on Wall Street.
And you wonder, maybe if they can get demand to slow down, maybe they get those costs of those items to come down. Yeah, it might cost you more to finance it, but the cost of the item itself maybe does finally start to come down and we see inflation lessening. The question is, what does this mean for investors and their money? Sometimes it feels good to look at that balance, and sometimes it feels absolutely horrible, like the other day when you're talking about just in those minutes that the Fed chairman's talking, man, things were just tanking.
Well, here's what I would anticipate. First of all, the market likes certainty. When it doesn't get that, it creates a lot of volatility. So one thing we know, I saw this report just before going on the air with you, typically about 46 days before the Fed begins to cut rates is when the market tends to jump up. And so here's the predicament. When will the Fed begin? At some point, they're going to raise rates in the short term, but when they begin to cut them, about 2 months prior to that is when the market tends to jump up the most. So you're going to want to be in the market then. But from now until then, I think we're going to see an intense amount of volatility. There's even quite a bit of charts and graphs that show we might see the S&P 500, those big blue chip companies, dip in the short term. So be prepared for volatility. If you're adding money, you've got a 401k, an IRA, you're adding money to regularly, it's good news because you're buying more shares with less money.
Yeah, and you just have to sort of be prepared at this point for, like you said, one of those really bumpy rides. Can your stomach handle, all of the ups and downs as you go through that? For someone who is just starting out investing, though, what sort of strategy do you give them right now if they don't have this, 401k or IRA or something that they've been putting money into a little bit at a time over a long period of time? What if they're just starting?
Well, you want to buy either Pepto-Bismol stock or Haagen-Dazs ice cream stock, however you cope with the stress. The bottom line is, if you're just now investing, this could be a golden ticket for you, because obviously the market's down, and we know when there's volatility, people tend not to invest. They tend to run from it. If you've got the stomach, got some courage with your investments, now could be a great time to ease money in. I call it dollar cost averaging, buying some each month. Some months you buy more, some months you buy less, but that can be a great way to lay a foundation for your future investment planning.
Yeah, Derek, on those really bad days, I just have to keep reminding myself, that Warren Buffett got super duper rich by buying when everybody else was selling. It's just a question of, are you buying the right things? And that's always the question.
That's exactly the question. That's right.
Derek Kinney, author of Good Money Revolution. Thanks as always for being on with us today.